interest rates, and demand for loans goes up. Demand for loans go up, money gets borrowed and invested, and economic activity picks up. Okay? That's how it works. All right. Let's see. Other tools available, the discount window. Okay? This is where the bank makes loans the Fed makes loans directly to banks. So if a bank can't borrow from another bank to meet their reserve requirements, they go to the Fed and they borrow directly from the Fed. The problem with that is the Fed makes it public. And so people, if one bank has trouble borrowing from other banks, then people get scared that that bank is in trouble and they make a run on the bank. Okay? Okay. So let's see what I want to say here. Okay, so how the bank makes credit available through the discount window also causes the supply of money to expand and contract. So the Federal Reserve can say no. They might have a rate available, but they can say no to a loan. Okay? And that affects the money supply. All right. So each bank has its own discount rate. And that really reflects what's going on in their district. Okay? So each of the districts will contribute an update at the FOMC meetings, at the Federal Reserve meetings, not the FOMC meetings. They will update everyone as to what's going on in their district. Because each district has a very different economy. Okay? So people are very interested from district to district to know what's going on in their district. And you have to have some flexibility about setting rates. It's a function of supply and demand. All right, reserve requirements. This is a third tool. Reserve requirements, okay? So again, these are capital requirements. They have to keep a percentage in reserve. And they either keep it in their vault or they have credit available at the central bank. And if the Federal Reserve raises requirements, okay, that means banks have to hold back more money, and that's less money to loan. It lowers the money supply if you raise reserve requirements. If you lower reserve requirements, which makes banks more risky, it expands the money supply. When you tell banks you don't have to hold as large a percentage, you can go ahead and loan that money. It expands the money supply. But this is not a tool that's used very often. And the discount rate is not a tool that is very important. But as we'll see, the discount, the availability, not the cost, but the availability of credit from the discount window is very important. Very important. All right. Moral suasion, this is when the central bank starts banging on the drums, getting on TV, making comments. Okay? So they can get in front of legislative committees, and let me tell you that it can get really tense. The Federal Reserve, I think twice a year, the Federal Reserve chairman has to go in front of Congress and testify as to what they see happening with the economy and what they're doing with a monetary policy. And then the Democrats will ask questions of the Federal Reserve Chairman to make the Republicans look bad. And then the Republicans will ask questions of the Federal Reserve Chairman to make the Democrats look bad. They talk about policies. They talk about issues like taxes, like immigration, healthcare. They talk about issues and possible solutions, and they want the Federal Reserve to say things that will make their policies look good and the other side's policies look bad. And you've got to be really smart and quick as a Federal Reserve Chairman to avoid those traps. Okay? All right, let's look at, and these are the new slides, central bank emergency programs. Because what's happened at the Fed is startling. It is startling. It is shocking what has happened at the Federal Reserve in the last 10 years. Okay, so the Federal Reserve has implemented numerous programs in the aftermath of the last two crises, 2009 and 2020. So 2009 really kind of started in late 2007, it really picked up speed, and the policy started changing in 2009. Okay? So I've got some quotes here. So, when the financial system is experiencing severe shocks, okay, the Fed is prepared to take extraordinary actions to keep disruptions from spreading across the financial sector and from spilling over to the broader economy. So the Fed is trying to calm things down. They don't want a domino effect that will spread across the financial system. They want to keep it localized, keep it as contained as possible. Think of it like an oil spill. You don't want that oil spreading out. You want to keep it contained quickly. If it starts to spread out, the damage is huge. And they don't want it to spill over into the economy. You've got the financial system and then you have the economy, and they're separate, but they're related. And you don't want a problem in the financial system to cause an economic problem. Okay? The financial and economic crisis, and this is another quote from somebody else, one of the vice chairs. The financial and economic crisis that started in 2007 tested central banks as they had not been tested for many decades. It was a once-in-a-lifetime event, and it required the Federal Reserve to do things they hadn't done. Okay? We needed to take swift and decisive action to limit the damage to the economy from the spreading distress in financial markets. Because the financial distress was so deep and pervasive, and because it took place in financial markets, the markets were affected. Financial markets, where securities are bought and sold, and whose structure had evolved dramatically. We had brand new products and markets that had changed significantly over the years, and the Federal Reserve and other regulators had not kept up. Our actions needed to be innovative if they were to have a chance of being effective. So Ben Bernanke was in control of the Fed when the crisis hit in 2007, 2008, and his PhD dissertation was about the policy mistakes the Federal Reserve made after the crash of '29. And he came out immediately and he said, I will not make those same mistakes. I will not allow the Federal Reserve or the Congress to make the same mistakes that led to the Great Depression. We could have avoided it, and we're going to. And we're going to do what it takes. All right, so the financial crisis of 2009. Ultimately, the Federal Reserve responded to the crisis by creating a range of emergency liquidity facilities to meet the funding needs of key non-bank market participants. Who are they talking about? The securities dealers, the mutual funds, okay, and the insurance companies. Non-bank. So they had to deal with the banks, but they also had to broaden it out. And we'll get to your presentations next time. Let's finish this. All right, so what did they do? Well, they made it easier to borrow from the discount window. Okay? There was a disruption in the federal funds market. Banks refused to loan to each other because Bank A, that had extra money, didn't know if Bank B would be able to repay the loans. So they said no. And they did it all across the system. And so Bank B that needed to borrow, they had to go to the discount window. So what the Federal Reserve and the Treasury Secretary did was he called all of the bank chairmen of the large banks together in Washington and said, you're all going to borrow from the window. And that way no one can tell which of you is in trouble. But you're all going to borrow. And it caused some of the strong banks to get very angry. HBO did a great docudrama on this process. Okay? They created the Term Asset-Backed Securities Loan Facility, where the Fed loaned directly to private companies. Okay? And this was new. They said, not only are we going to loan money to member banks, but we'll loan to investment banks, non-member banks, and to insurance companies, because they were all in trouble. They needed liquidity. Okay? This was a biggie. To reduce longer-term interest rates, they initiated large-scale purchases of longer-term securities. They had not done this before, and they had to go to Congress and get the laws passed that enabled them to buy securities from the banks. The banks had invested in a bunch of really crappy securities. And the Federal Reserve stepped in as a buyer. The problem is, you got this supply and you had demand. And in a normal market, the mechanism that clears that is price. And it didn't work because demand just evaporated. And people said, well, yesterday they were trading for 100% of par, and today they're trading at 30% of par. And the true value was probably somewhere around 60% of par. So how do you stabilize the market? You've got to be a buyer. And the Federal Reserve became the buyer. They stepped in. Okay? And this is kind of Keynesian. Keynes said that if the consumer is not going to step in and buy, then the government needs to lead the way. And that's what happened. That's what happened. All right. So then we had the COVID crisis. All right. What did they do? Three things. One, they lowered interest rates again. So right before COVID hit, short-term interest rates were a little bit above 2%. And zing, straight down they went, just like they did from here to here back in 2008. They did the same thing in 2008. We had a crisis. They flooded the system with money, caused interest rates to go down to try to stabilize the economy. And they kept interest rates low until things started getting a little bit better. Things were getting better, and all of a sudden COVID hit, and boom, down we go again. Okay? And this causes all kinds of problems. It's a short-term solution, but it causes all kinds of problems. All right, stabilizing the financial markets, just like what happened in 2008. The primary tool the Fed employs to stabilize the financial markets is to purchase securities that are difficult to sell. This is the balance sheet of the Federal Reserve. Okay, this is what they own. These are the securities that they own. And what you can see is it was just under $1 trillion here. Okay, then in late 2008, swing, up it goes. Why? They needed to provide liquidity to the banks, so they started buying these assets from the banks. And they kept that up for a long time, and they tried to start unwinding it, finally starting to sell some of those securities because things looked good, and we ran into COVID. And once we ran into COVID, same thing happened. They said, we did it before, we'll do it again. COVID caused an economic problem. The financial crisis was a system problem. It wasn't an economic problem. It was a financial system problem. But the Federal Reserve responded in the same way. I think we have one more slide. All right. Supporting the availability of credit. So they lowered interest rates, they lowered the cost of loans, then they provided liquidity to the markets, and then they created these loan facilities again. And you've heard of this one, this was the biggie. The CARES Act, they work with the Congress to create the CARES Act, to implement the CARES Act, the Paycheck Protection Program. Which sounds good, but the truth is, while it costs the government trillions of dollars, it provides very little to consumers. And it's not going to the right people. And it was super difficult to get it implemented. Once again, the government says, okay, we're going to do something. And it was so difficult for people to get their money. And the rules kept changing, and there was a lot of confusion. And they were working through the banks, and a lot of the banks weren't set up to handle the volume. It was terrible. And now they're trying it again. Now they're trying it again. Okay? So, whoops. There you go. So, once again, one of the lessons to be learned is government, there are certain things the government can do, but the government is clumsy. That's just the nature of the game. Governments are corrupt and clumsy. And it's dangerous to ask the government to do things. It just doesn't work very well. All right, so we'll start class. Let's see, so we've done 1 and 2. I think the first test does the first test have 4 chapters in it? I'll take it. But we'll start. You guys will make your presentation, and Colin and David can do this too. Accommodative monetary, monetizing the debt. Monetizing the debt. All right. Peace out. Don't say anything that you don't want the public to know.